Right now, many property investors are making a mistake that's going to cost them everything. They're buying in areas they think are good suburbs. They're buying in areas they think they're familiar with. And in 12 months' time, many of these investors are going to watch their properties drop by $100,000 in value, while at the same time, other suburbs, even in the same city, skyrocket. Now, I know this because over nearly the past decade, I've helped clients invest millions into property, and I've seen firsthand which areas grow and which ones crash. Yes, Australian house prices, they are rising at the fastest rate they have in 4 years, but that doesn't mean that every suburb is rising with them. Get this wrong, and you're not just losing potentially the 100K that maybe the property you bought drops in value, you're also losing the $100,000 you could have made by buying a property in a different area that rises in value. So that's a potential $200,000 swing in just 12 months. That's why today I'm going to show you the 5 types of areas that I think are going to crash in 2026 and the 1 type of area that will continue to keep growing no matter what, and the specific data points you need to check before you invest anywhere. You see, most people seem to think that they can pick a winning suburb based on like gut feel. They assume, for example, that capital cities are safer than regional areas, or that a suburb with like a good reputation can't possibly fall in value. But take a look at the recent data from realestate.com.au. There are suburbs here that right now most people would confidently call good areas that have dropped significantly in value. Some of these are in major capital cities. Some are in neighborhoods people grew up in and would swear by. Yet, the data doesn't lie. These areas are falling, and the investors who bought there based on familiarity or reputation, they're watching their equity evaporate. Now, you might be wondering, how can that be? After all, Australian house prices are rising at the fastest rate they have in 4 years. Well, here's the problem. Not every suburb is participating in that growth. In fact, while some areas are booming, others are quietly bleeding in value. And the difference between the two has got nothing to do with whether you like an area or how close you live to it, or even if it's in a capital city or not. Instead, it comes down to whether the property you're looking to buy is in an area that meets any of these 5 criteria. And if it does, the odds are you're going to end up buying a property that you'll regret. Number 1, areas without sufficient owner-occupier demand. You see, most people seem to obsess over new builds. They hear about a new development going up and they either think that's a good thing, or on the flip side, they immediately panic about oversupply. Or they think investor demand, where their friends are investing, that's what's going to drive prices up. Unfortunately, that's wrong on all counts. What actually matters is the excess of owner-occupier demand, people who want to buy to live in an area versus the available supply. Now, here's a critical part that most people miss. Supply doesn't just come from new builds. In fact, the more important source is actually the existing properties for sale. You see, if the number of existing properties listed for sale is dropping compared to a year ago, that tells you something powerful. It means people are buying in that area and they are staying there longer. They're not just buying for a short-term gain. They're not selling. They're putting down roots. And when owner-occupiers hold on to their properties for longer, supply tightens and prices rise. But areas without that excess owner-occupier demand that might be rising right now, well, they're typically investor hotspots where everyone's competing to buy, then almost everyone's competing to find a tenant, and then eventually they're all competing to sell. And when that selling wave hits, prices crash. So before you buy in any suburb, check 2 things. First, how many new builds are being approved. Check building approvals. Second, and more importantly, compare the number of properties listed for sale today versus the same period 12 months ago. If listings are down and owner-occupiers are moving in, you're onto something. But on the flip side, if listings are increasing or it's mainly investors buying, That's your first warning sign of a market that comes with some serious risks. Now, I've spent years studying what actually makes money in property, not what sounds good at dinner parties. So if you'd like to see exactly how I personally build passive income from property based on my now 23 years of experience, I put everything I've learned into a free ebook you can download totally for free using the link in the description below. Number 2, areas without sufficient selling momentum. Most people, they seem to rely on past growth to predict future performance. They either look at what an area did last year and assume that if an area has already grown, maybe it can't grow anymore. Or if an area has not grown in value in the past, then it's more likely to grow because it just has to. But past performance doesn't tell you what's happening right now, and it's definitely no indication of what's likely to happen in the future. That's why relying on past data can often result in many people getting burnt. For example, I know of many people who bought in Melbourne in 2017. Their rationale was, it's our second biggest capital city, it's got massive migration, prices have risen, it's just going to keep growing in value. But what happened? Prices fell in most of Melbourne from like 2017 until late 2024 or early 2025, depending on which suburb. Now that's 7 or 8 years where many of these buyers saw zero growth, and worse, in many cases, their properties actually fell in value. Now, while some people might say, yeah, but property is a long-term game, fair enough, but consider this. There was a huge opportunity cost because while these investors were sitting on their property that either wasn't rising in value or even falling in value, investors who bought in other areas around Australia, often for less, made many hundreds of thousands of dollars in capital gain. Now, to make this real, let me ask you a question. If you bought a property today for like $800,000, and let's say it even went up to $820,000 in 5 years, meanwhile, someone else bought a property in a different area, again for $800,000, but 5 years later, that property was worth $1.2 million versus yours only now being worth $820,000, would you feel like you'd actually made money, or would you feel like you actually lost money? The answer's pretty obvious, right? You'd feel like you lost out. So to avoid that kind of situation, don't look at past data. Instead, look at selling momentum. It's one of the most reliable leading indicators you can track, and it's simple. Just look at how fast a property is selling today compared to a year ago. If property is selling faster, there's only one reason. Demand is rising relative to supply. And as my economics professor would say, whenever demand rises relative to supply, price increases follows. It's not a maybe, it's actually a certainty. But if properties are like sitting on the market for longer than they did a year ago, that's your warning sign. Buyers are hesitating, demand is softening, and prices are about to crash. Areas with slowing selling momentum are areas where the market has already turned. It's just that most people, they haven't realized it yet because they're relying on past price growth data. So track days on market. Compare the average time it takes for a property to sell today versus 12 months ago. If it's increasing, if properties are taking longer to sell, you're looking at a market that's losing steam. Avoid these areas at all costs. Number 3, areas with very few offers made on properties. You see, many people think that if a few properties are selling, that's enough to gauge market strength. They see a sale or two and assume the market is fine. Let me give you, though, a real example from the opposite end of the spectrum. In a regional market we're buying in quite heavily for clients right now, an area where the free data online will tell you prices haven't risen much. It's not an area that's very hot. We've recently tracked 2 properties. On the first property, there were 16 offers made on that property. On the second, there were 20 offers. That's 36 offers across just 2 properties in a single week. Now, without stating the obvious, only 2 sets of buyers could walk away with those properties. That means there are 34 buyers still out there hunting, frustrated, and willing to pay more the next time a similar property hits the market. Now, that's not speculation. That's momentum building in real time. That's an area set for some spectacular price growth. So if someone asks me, hey, Nero, tell me that a property market is hot without telling me a property market is hot, here's what I would do. I track the number of offers being made on properties. When you see multiple offers consistently coming through on properties, you know that demand is outstripping supply. And that means that prices are about to move fast. But areas where this isn't happening, that tells you the exact opposite. It means buyers aren't competing. They're not in a hurry. They have options. And when buyers have the luxury of time and choice, what do? They negotiate down. And that means prices often end up stagnating. Eventually, they fall. But this kind of information, it's not publicly available. You can't just go to a website. It takes work. It takes on-the-ground knowledge and the willingness to make lots of phone calls to agents, attend open homes, and be on the ground. But is it worth it? Absolutely, because this single metric tells you more about future price direction than almost anything else. So start building relationships with real estate agents in the areas you're targeting. Ask them directly, how many offers are properties getting? Are buyers competing? Are sales going above the asking price? If the answer is no, or if they're struggling even to get a single decent offer, that's an area that's in trouble. Number 4, areas without the right infrastructure. This is something so many people miss. Everyone seems to be talking about job creating infrastructure, new roads, new business hubs, new employment centers, and yes, those matter. But most people completely ignore livability related infrastructure. And that's a huge mistake. They assume that as long as jobs are coming, people will follow. But it doesn't work that way. For example, right now, there are a lot of mining towns that properties are rising in value in and rental yields are rising right now. So sounds perfect, right? Well, here's the downside risk. The main type of buyer in these areas is usually an investor. It's not an owner-occupier. People aren't actually moving to live in these areas long term. And most of the people who are moving there, they're just renting. They're there for work. But once the jobs dries up, what do you think is going to happen? They will move back home and you're going to be left with a property that you're going to struggle to rent and you're going to struggle to sell. And we've seen this before. For example, we saw properties in Newman in Western Australia drop by over 50% in value when this happened last time. Now imagine that you buy a property and then shortly afterwards, it drops in value by 50% and your rents drop maybe 80% if you can find a tenant at all. Would you really want to take that kind of risk? I know I wouldn't. So instead, focus on owner-occupier demand. Is the average buyer someone who wants to actually buy to live there? Then ask what actually attracts young families to move into an area and stay there long term. It's not just jobs, it's quality of life, sporting facilities, it's good schools, parks, shopping centers, cafes, community spaces. Probably some of the things that you would look for if you wanted to buy to move and live in an area. So when you see a council investing heavily in livability type infrastructure like upgrading schools, building new sports complexes, one of my favorites is new aquatic centers, and also improving public transport, that's a signal. It means the area is preparing for population growth. It means the local government believes people will want to live there and they're preparing for it. And it means owner-occupiers will follow. But areas without this kind of investment into livability-based infrastructure, they're not going to attract families to come and live there. And without that influx of owner-occupiers, demand eventually dries up and prices either stagnate or worst case, they crash. So job infrastructure, it gets people into an area. But livability-based infrastructure, that's what makes people stay. And if people don't stay in an area, prices don't grow. So don't just research employment hubs. Look at council plans for schools, parks, recreation centers, and transport upgrades. Check if new shopping precincts or family-friendly amenities are being built. Because, again, if the area isn't investing in livability, it's not positioning itself for growth. It's actually positioning itself for an eventual decline. Number 5, areas without sufficient economic strength or diversity. Many first-time investors are making this mistake, and I've seen others make it time and time again. They see a booming industry in a town, they see prices rising, and they assume that's enough. Think about, for example, Townsville in Queensland. It used to be an area heavily reliant on mining, and prices were rising. But when the mining industry slowed from 2010, prices dropped, and they kept dropping for nearly a decade. People who bought at the peak watched their properties lose value year after year. But then something changed. Townsville diversified. New industries moved in. Jobs became available across multiple sectors. The town attracted people looking for a lifestyle, not just work. Now, of course, this took a few years, but eventually it reached a tipping point. And then what happened? Townsville became one of the fastest growing property markets in the country. Many of our clients who bought there during the recovery, they've seen their properties double in value. That's the power of economic diversity. You don't want to buy in areas that are like mining towns or tourism heavy towns. These are industries that are heavily volatile. So when the industry booms, prices skyrocket. But when they go bust, the whole area collapses with it, and it can take years to recover. That's why I say areas without sufficient economic diversity, they're ticking time bombs. They might look great today. You might have lots of friends telling you to buy there. You might have certain other advisors telling you that you should buy there. But one industry downturn, one policy change, one global shift, and that entire area crashes hard. Instead, you want to buy in areas with jobs across multiple industries: healthcare, education, retail, government, manufacturing, logistics, a healthy mix. Because then if one industry shuts down, the whole town doesn't shut down with it. People still have jobs, they can still buy houses, and prices remain stable, and many times they keep growing. So before you invest, research the local economy of the area. Check the data on employment by industry. If one single industry accounts for more than 30 or 40% of local jobs, that's a massive red flags. Instead, look for areas with at least 3, 4, or 5 diverse employment sectors. That's your insurance policy against a crash. Now, after everything we've just covered, this brings us to the one type of area that consistently survives downturns and often grows while others fall. Hopefully, though, by now, you can see that just because you feel you know an area or you're familiar with an area, that does not mean the prices are going to grow, even if they've grown in the past. For example, I've seen people buy properties in Sydney or Melbourne in the past only to see their property either fall in value or realize that they could have done way better if they'd known how to find the right areas to invest in. So how do you find the best areas to invest in? What's one criterion you need to focus on to find property that's likely to outperform? It's simply this: focus on areas where there is more consistent demand from owner-occupiers than supply of properties. That is it. Buy in areas where more people actually want to buy homes to live in than the available supply of properties. Now, this is not going to come from a free website or even some of the paid tools out there. It only really comes from being on the ground, attending open homes and auctions, speaking to other buyers, speaking to selling agents. It is a laborious process, but it's one that will give you better results than almost anything you're going to do. For example, maybe you're considering buying a property in an area, but it's already grown in value and now you're not sure, is that area going to keep growing? Well, if so, ask yourself this question: who is still buying? Are they buying to live there? And do they have the ability to afford higher prices? Because if they do, then you can be confident that prices will continue to rise regardless of how much they have grown in the past. Also, look at how many offers are being made on properties, how many people are attending open homes and auctions. Look at what will attract owner-occupiers to keep wanting to move into these areas. Track these factors and you'll find an area that will continue to grow in value and likely outperform the national average. Now, it's one thing to understand which areas are dangerous. It's another thing entirely to apply this properly with real money on the line. So if you want a personalized strategy using the very same approach we use with our own clients, you can book a totally free call with a member of my team and take the proven passive investor approach. Let's make sure that your next investment property is in an area that thrives, not one that crashes. So now that you know how to find the best areas to invest in, that's still only half the battle though. The other half is knowing how to structure your investments to actually generate passive income, the kind that pays you month after month without you really having to lift a finger. So watch this video next where I break down the 10 steps to make $10,000 per month with property. It's the exact same blueprint our clients use to turn property into a predictable, passive cash flow machine.